conventional versus FHA versus VA loans. A lot of times people are confused about when one is appropriate versus another, so we're going to take somewhat of a deep dive into that. And we'll start with looking at a table, just comparing some of the basic features of that. And that's super helpful, but there's so many nuances and so much of the decision making with regard to that is very situational that it's really impossible to really cover everything, even in a longer video, but certainly with a table. But we'll start there because it will give us some useful differentiators between those different programs, things to keep in mind, to know about when you're deciding, if you're fortunate enough to have all three available to you, conventional, FHA, and VA, which would you choose? Now, most people aren't eligible for VA, and so that's going to be a much smaller slice of the population, but that's useful to know as well. Most people are eligible for conventional, of course, and FHA. So we'll take a look at those. We'll start with the table, kind of just take a look in comparing different features, strengths, and weaknesses of each program. And then we'll look into some specific situations. We'll look at someone with 20% down and good credit, someone with 20% down and lower credit. What about 5% down, good, and lower credit? What about 3.5% down? And we'll just look at that just to kind of give you a little bit more concrete understanding of that. I'll try and get my super duper tech guy to put links into the video so you can go to specific time marks if you have a specific situation you want to look at. And you can always reach out and talk to me. I'm happy to help you in any way. I'm licensed in Washington and Idaho, but most of these principles apply everywhere, and so I'm happy to consult with you, give you any information I can, direct you to someone who can help you. So anyway, let's just get started on this. So we're going to do a deep dive here. So first of all, let's just start with definitions. Conventional, what is a conventional loan? Conventional basically means it's not VA, FHA, or USDA. You'll notice all three of those, VA, FHA, and USDA, are government entities. And so they have government programs that are explicitly guaranteed, or the loan is guaranteed by the government program. Conventional is not. So when a lender makes a conventional loan to you, the government's not guaranteeing that you're going to pay that back, or guaranteeing to the lender that they'll make them whole, or at least up to a certain percentage, should you not pay them back. So these are conventional loans, and conventional loans are generally, they can be jumbo loans, they can be conforming. Conforming are the ones that are within the Fannie Freddie guidelines, and that's really what we're going to be talking about today for the most part. We're really not going to be touching on jumbo. So conforming conventional loans, they're saleable to Fannie Mae and Freddie Mac. They fit within their box, within their guidelines, and they're not guaranteed by the federal government. Now, we saw back in 2007, 2008, 2009, when we had that big crash, that the federal government did step in and guarantee these loans anyway, because it would have been too catastrophic in their view to let them fail. And so they sort of had a de facto guarantee, but the loans themselves are not guaranteed. Now, do keep in mind that the reason Fannie and Freddie occupy most of the space in mortgage, about 70% of all mortgages that originate in the United States, is because the federal government does guarantee the borrowing of Fannie and Freddie Mae when they go, Fannie Mae and Freddie Mac, when they go out and borrow money so that they can lend it to us. And the federal government says to people who buy those bonds to lend money to Fannie and Freddie, to say, look, we've got the full backing of the federal government, and that makes that borrowing cheaper for Fannie Mae and Freddie Mac. If you're a private corporation that might go bankrupt, there's a risk factor that goes into people who lend money to those corporations, and that increases the cost. But when the federal government's backing it, which has never defaulted, then they are going to exact a lower risk premium. You'll have lower rates, and then those, in theory, get passed on to you and me. So that's kind of what a conventional loan is. FHA are loans guaranteed by the Federal Housing Administration. And in that case, the government does explicitly insure to lenders, saying, look, if you can't collect, if this goes into foreclosure default and you don't get all your money back, we will guarantee up to a percentage of that loan amount so that they can take on riskier loans. And that was why they were created, to allow banks to take on riskier loans to facilitate home ownership. Same with the VA, guaranteed by the Department of Veteran Affairs. Again, that's an explicit guarantee. and they insure lenders against a portion of the loss, so riskier loans can be made. And they also are lower down payment programs. That was also one of the key features of a VA loan, is that they're zero down payment loans. And of course, they're only available to eligible veterans. So let's move on to the next page. I want to tell you a little bit about Fannie Mae and Freddie Mac. I'm not going to go into deep dive here, but just how and why they were created. Fannie Mae, Federal National Mortgage Association, official name, created in 1938, part of the New Deal. Remember, this is coming out of the Great Depression, and these are, they created this Fannie Mae called a government-sponsored enterprise. Not explicitly owned, they're a private company, but they're government-sponsored in that's where the government steps in and guarantees their bonds, and that facilitates liquidity in the market. And it was created to do just that. You remember Great Depression, 1938, people having a hard time buying houses, qualifying for loans, and so Fannie Mae gets created in order to facilitate this, to allow lower down payment programs to come into the market, and more riskier profiles in general. Now, Freddie Mac was created later, Federal Home Loan Mortgage Corporation in 1970, basically to provide competition. What the federal government realizes, look, we've created this sort of uber government-backed monopoly in Fannie Mae, and that's not a good thing. Without any competition, they can basically do whatever they want in the marketplace. So we want to create another entity, and they're very much alike one another in terms of what they do. There's slight nuanced differences between them, so it's good to have access to both. Most mortgage brokers do, probably many banks do too, but that's the genesis of Fannie Mae and Freddie Mac. FHA, very similar, was created a little bit before that. That was kind of the first low down payment program, some of the earliest low down payment programs, created in 1934, again, kind of in the wake of the Great Depression, to stimulate the housing market. And then the VA loan program, the VA existed long before this, but was created in 1944 as part of the GI Bill, and that was to provide returning World War II veterans with a path to ownership. So now let's get into the nitty gritty. Okay, let's really kind of compare these features, and we're going to talk about this. There isn't a really good logical order, I'm afraid, to kind of these features that I'm going to go through, but I do think it covers some of the more important features, differences between them. And so let's start with, for example, condominium. Property types are one of the weaknesses if you're going to use an FHA or a VA loan. One of those property types that is most impacted is condominiums. For conventional loans, most are allowed. There's a concept called a warrantable condo, and basically it has to do with how many of these is the condominium complex complete. Did we just finish a couple and there's a whole bunch more to be built? Most lenders aren't going to go in and do those early on, so it has to be warrantable. But generally most condos are allowed, whereas FHA and VA, you have to be specifically on their approved list in order to finance a condo with a VA or an FHA loan. And so that the vast majority of condos are not on that list, or maybe once upon a time were on that list, but their approval has expired. And so you really have to kind of be on the lookout if you're coming with an FHA or a VA loan. Now, it is possible to do what's called spot approvals for an FHA or a VA loan. But that is going to be a hurdle for sellers to want to consider your offer. So they have to be a little bit more patient. And they have to be a little bit more risk. They have to accept a little more risk that there's not a guarantee that those spot approvals will get done. Now, like I said, they can be done and often are done, but it takes several weeks to get those done, so you need to add more time. Probably one of the biggest weaknesses relative to conventional loans for an FHA and VA is something called the amendatory clause. And a lot of realtors aren't aware of this, a lot of lenders aren't aware of this. But basically, both VA and FHA require, as a condition of approving a loan, of giving a loan, that all the parties, meaning the seller, the seller's realtor, the buyer, the buyer's realtor, sign what's called the amendatory clause. And the amendatory clause basically says that no matter what else you agree to, no matter how explicit you agree to it in this contract, you cannot require this borrower, buyer, to make good on the contract if the appraisal comes in low. Now, the borrower or buyer can, if they want to, when the appraisal comes in, if it comes in low, they can, if they want to, say, no, I want to go ahead with this anyway, I have the means of doing so, let's move forward. They're perfectly able and allowed to do that. but they're not allowed to get into contract in such a way as they don't have an out if the appraisal comes in low. So if the appraisal comes in $1 low, they can walk and get their earnest money back. And so that, particularly when we were in that white hot seller's market a couple of years ago, that was a real barrier for a lot of people to come with an FHA or a VA loan, because that meant that if you had multiple cash offers, you had other offers that were waiving the appraisal. Well, if you waive the appraisal and you have an FHA or VA loan, that waiver is moot. It's overridden by the amendatory clause. And so sellers just had to be aware of that. So that is certainly a feature that favors the conventional loan for sellers, and then for buyers as well in terms of the strength of your offer. Multifamily is another property type that has some nuances with regard to Fannie, FHA and VA. Conventional lending. Now, multifamily, when you're talking 1 to 4 family residence, a single family, a duplex, a triplex, or a fourplex. Once you go over a fourplex, then you're into commercial lending that's not covered by Fannie or Freddie or FHA, typically, or VA. So conventional, basically, they're going to allow multifamily. FHA does, but they have what's called the self-sufficiency test. The self-sufficiency test basically states that property has to cover the mortgage in rental value. So if you buy a 3-unit property, you have to value all 3 units. Now remember, FHA and VA are only owner-occupied programs. You can't buy that as strictly an investor. However, if you occupy one of the units, that's treated as owner-occupied, and then you can finance what it turns out to be an investment property up to a fourplex. However, if you have a 3 or a fourplex, it has to pass the self-sufficiency test, which basically says that that unit has to cash flow. If the mortgage payment and the housing costs, taxes, insurance, homeowners association, any of that stuff, that total mortgage payment has to be less than the rental value of all of the units. They don't exclude the unit that you're going to occupy and live in, but that can be a real hurdle, especially in this higher rate environment, so just be aware of that. Now, one of the benefits of FHA, conventional, generally once you get into a duplex, you have to have 15% down, so you can't go with that lower down payment program. FHA, not so. I think you can go 5% down on an FHA, on a duplex. Now, on a duplex, you don't have to meet the self-sufficiency test, so those are a lot easier to do, whereas 3 to 4 units, you do have to do that. And then VA, they will do a multifamily, but prior rental experience is required. So you have to demonstrate sometimes 2 years, I think, of prior history of showing on your tax return that I've been a landlord before. I've been able to manage rental property, and so that might be a limiting factor. Let's talk about the appraisal. One of the things about conventional loans is waivers are allowed. We've seen quite a few of those. The frequency of getting an appraisal waiver, basically you run the loan through electronic underwriting, you put the purchase price in there, you put the borrower's profile, the credit, the down payment, the loan to value, all those things in there. And electronic underwriting may come back and says, look, we're happy with the value, you don't need to get an appraisal. And that saves you a lot of money, but maybe more importantly in a purchase market where it's still competitive. Even today, it's still competitive in many markets, and ours it is. It's not white hot like it was before, but it's still competitive. Frequently you're bidding against others. Having an appraisal waiver is a big deal. It means you can go faster. You don't have the uncertainty of the appraisal. And the other thing is all licensed appraisers can do a conventional appraisal. That's not the case with FHA and VA. With FHA, you have to have a FHA certified appraisal, and they have to do it on a separate form. You don't get waivers on an FHA. You need a specialist. And there's generally stricter property standards. Both FHA and VA have generally stricter property standards, where if something might pass on a conventional loan, maybe some peeling paint, chipping paint, they're just not quite as strict there. Now, I want to make a big caveat here. I know some colleagues of mine whom I respect, who get really angry whenever you mention that there are potentially negative perceptions about VA loans. And they get really angry at lenders who want to talk about those because they think it dishonors a veteran. And I'm 100% with them in terms of wanting to honor our veterans, but I think honor doesn't involve not just talking frankly about some of the differences. If you're a seller in the marketplace and a VA borrower comes to you and makes an offer, even if it's 20% down, and a conventional comes to you and it's 20% down, you are going to at least consider the conventional versus the VA because you don't have to sign that amendatory clause. And especially if we go back again a couple of years ago when prices were escalating, buyers were waiving appraisal, well, they can't do that with a VA. And so there are some things that are just not as strong with a VA loan. They're great loans for great people, and we should make every effort to make sure people are educated about those and get those loans and they're able to win deals, but not with kind of our head in the sand and kind of ignoring the fact that they're, in some situations, they're not just going to be quite as attractive. And in that case, a veteran may have the option of going conventional or VA, and they may be pretty similar. And so in that case, it might behoove them to say, look, you're going to have a stronger offer, take the conventional, and let's go with the conventional, and we'll be better off, and you'll win the deal, and get similar financing terms. So anyway, that's enough of that. But they do tend to be stricter property standards. Same with VA. Now the VA, they have their own appraisers that are assigned. Now this, years and years ago, that used to be a real problem. That used to be kind of the typical government bureaucracy, and it was a little bit of a nightmare. That's gotten so much better. So I would say, just in terms of efficiency of getting the deal done, VA is on par with FHA and conventional. Conventional has a slight edge just because it's completely private. You have all kinds of appraisers in the market that jump on that, so it tends to have a slight edge in terms of efficiency and getting the deal done. But really, FHA and VA, we can deliver those really reliably, really fast. And VA appraisers are doing a great job. Credit, see my typo here, a little de-org seasoning, that's meant to be de-rog. So credit, 620 minimum for conventional. FHA, 500 if 10% down. Now, you still have to qualify. You still have to run through electronic underwriting and get the approval. And if you have 500 credit score, you might not get that. But they will go down that far if you can get the approval. Or 580 normally. VA, they don't have a minimum credit score. However, this is subject to lender discretion. And even though VA doesn't set a minimum credit score, many lenders will. And many lenders, these are called overlays, where lenders say, look, even though the program itself doesn't require this, we feel more comfortable setting some sort of a limitation on that. And they have some responsibilities with regard to putting people into loans that they can qualify for. So there's reason for them to do that. So you might see 580 to 620, even though VA doesn't have a stated minimum. Now, DROG seasoning, what's that? If you had a major derogatory credit event in your history, in your recent history, say, conventional is far more restrictive in terms of that. Typically, I think it's 7 years for foreclosure, maybe 4 for bankruptcy. I'll have to go back and look at those things. But it's much longer than for FHA. And VA and FHA have much shorter derogatory seasoning. So if you had a foreclosure in your past, if you had a bankruptcy in your past, they will let you back into the credit market, to the housing market, much faster than conventional will. So you want to keep that in mind. Investment property, conventional, yes. Absolutely, you can do rental properties, owner-occupied, second homes. FHA, no. Yes to multifamily. We talked about that a little bit. That's kind of a backdoor investment where you buy a multifamily, a duplex or a triplex or a fourplex, and you rent 1, 2, 3 units. So you can do that, but just on a single investment property, you can't use an FHA to do that. And same with VA. Same with VA there. Only first-time home buyers. You notice they're all no. So why did I include this here? I think there is a common misperception or misconception that a lot of people think FHA loans are only for first-time home buyers, and that's just not the case. Nothing to do with that. Now, I say nothing to do with that. I think they were created to foster with homeownership with first-time home buyers in mind, but they're definitely not limited to that. So no required, no look back into your home history to decide whether or not you can access this program or not. And VA is the same thing. No first time. Debt-to-income ratio. So let's talk a little bit about that. Both conventional and FHA loans use a debt-to-income ratio, basically where they're taking your housing cost, and that's principal and interest, mortgage insurance, taxes, homeowners dues, property insurance on a monthly basis, and dividing that by your gross monthly income. And that's your front-end ratio. And then they'll take those costs and add any other debts, car payments, student loans, credit cards, any of that kind of thing, and they'll and they'll add that to your housing cost and divide that. And that's called the front end and the back end ratio. Now conventional, I just showed one number here. You see here, 50% hard stop. Well, the reason for that is, conventional tends to not look at the front and the back end separately. They might. Sometimes it's all part of the electronic underwriting, but generally if you get to 50%, a lot of times you can get an approval, even if 100% of that debt is all related to housing. So your front end ratio is 50 and your back end ratio is 50. And there's a hard stop there at 50. Now FHA tends to have a hard stop on the front end of 57, but then they'll go to 47, but then they'll go to 57 on the back end. And so therefore you can see a situation where maybe you can qualify for more on a conventional loan if you have no other debt. But if you have some other debt like student loans or car loans, those sorts of things, maybe your FHA will be the better situation because your back end goes over 50 and you're not going to get approved with the conventional loan, but maybe you'll get approved with FHA. And then VA is unique in that they don't use the debt to income ratio, they apply what's called the residual income test. And basically with the residual income test, they take a look at your family situation. They say, okay, how many are in your household? Do you have, husband, a wife, a couple of kids? And then what region of the country do you live in? And depending on what your household size is and what region of the country you live in, then they're going to say, okay, well, you need residual income of $900 a month. And then they will take your income, your gross income, and they'll deduct payroll taxes. They'll deduct a maintenance factor based upon the square footage of the house you want to buy. They'll deduct any debts that you have. They'll deduct the housing cost. And they have to come up with at least that much residual income. Now, with that test, debt-to-income ratios can actually be quite a bit higher than what you can see in FHA and VA sometimes. So just kind of be aware of that. It's just very particular. You have to kind of go through the test and figure that out. Loan limits, conventional, much higher than FHA typically. Now loan limits has a conforming loan limit of $776,200. Now we can talk a little bit. We're not going to go into much detail. Fannie used to just be there's a conforming loan limit, and then above that you were in a jumbo loan, and you weren't within Fannie and Freddie's universe. You didn't get the benefited rates. When the crash happened, a lot of the jumbos pulled back, but there were still some areas in the country where pricing was high, and the conforming loan limits just weren't enough to get that done. And so Fannie and Freddie stepped in and said, look, we're going to create this, because jumbo kind of went away with the crash for a while. It was super expensive and they just stopped lending there. And they were like, we have all these, basically normal people, moderate income people in high cost areas that are being priced out of the market because the credit is frozen for jumbo. So they created this kind of high balance for certain counties. So 776-200 is everywhere. And then if you're in a high balance county like I am in King County, Washington, kind of the Bellevue, Seattle area, you're going to have higher limits, almost up to $1 million. But the pricing and the guidelines are slightly different there. With FHA, everywhere in the country is 472,030. So it's much lower, and you have to be aware of that when you're shopping, particularly if you're in a high cost area. Now they do have high balance as well. And so you can find high balance counties that will go above the 472,030, but just be aware of that there are different limits. And then VA, 2 or 3 years ago, basically eliminated all limits whatsoever. And we all kind of were somewhat incredulous when that happened and thinking, we hadn't really heard properly, didn't understand properly, it's always in the details, but they really have no limit. So you can borrow as much as you need to. Now I say that, but virtually every lender has a limit, and they'll state their limits. And so this is very kind of lender discretion again, that they want to sell to VA. How much are they comfortable taking on? But just be aware of that there is no limit on the VA loan amounts. And the minimum down payments, conventional are 5% unless you're a first-time home buyer, and then you can go as low as 3%. And FHA is 3.5%, and then VA is 0%. So anyway, that's kind of the chart. Now I want to move over to some detailed comparisons based upon specific circumstances, situations. So let's take a look. The first one I've got here is, let's just look at someone with good credit and 20% down. Okay, it's a $500,000 loan. It's a 30-year fixed rate. And what I've got here is 5 different categories, or 5 different columns. And what I'm comparing here is just the basic conventional loan, and then the conventional loan for a qualifying first-time home buyer. And when I say qualifying first-time home buyer, what I mean by that is a first-time home buyer whose income is not greater than 100% of area median income. And you can go on the Fannie Freddie website and just Google what is the income limitation for Fannie Freddie programs. What is the area median income? Put your address in there, it'll come up and tell you your area median income. In King County, for example, Snow County, it's about 125,000. And so now, again, in these high balance counties, they'll actually let you go to 120% of area median income and still qualify for these programs. And basically what these first-time homebuyer programs do is Fannie and Freddie say, look, normally we will take a loan and we'll have a base price for a loan, and then we're going to adjust it for different features, what your credit score is, what your loan to value is, what kind of property type it is it a condo, is it a manufactured home, is it a single family, is it a duplex, and we're just going to ignore all those because we want to facilitate home ownership for first-time home buyers, particularly those who have incomes at or below the area median income. And so that's what we're calling a qualifying first-time home buyer in this column, and we'll see some differences here. And then you have FHA, and then we have VA first use and VA not first use or subsequent use is how it's called in the industry. And basically the reason you differentiate there is because VA has what's called a funding fee. So does FHA. They both have what's called an upfront mortgage insurance premium or a funding fee, and it's quite significant. It's actually quite a large cost. Now both of them roll it into the loan, so it doesn't increase the amount of cash you need to bring to the table, but it is an expense. And the thing that you need to be aware of with regard to VA is the first use and subsequent use. So the first time you use your VA benefit. Now this is different than a first-time home buyer. A first-time home buyer for conventional purposes is anyone who hasn't owned a home in the last 3 years. So you could have owned a dozen homes in your lifetime, but still be a first-time home buyer because you haven't owned one in the last 3 years and don't presently own one. That would make you a first-time home buyer. It's not the same thing for VA. VA is first use and subsequent use. So the very first time you use your VA benefit for a mortgage loan, that's your first use. Any subsequent time is considered a subsequent use, and the funding fee can be different. A couple of things to note about that. First of all, the difference doesn't kick in until you get to 5% down or less. So right now we're illustrating some 20% down scenarios. We're going to look at 5% down and then 3.5% down. But the difference doesn't factor in until you get to less than 20% down. So you see here first use and subsequent use are the same funding fee for VA. Now FHA is the same all the way across the board. No matter if you put 50% down or if you put 3.5% down, you're going to pay the same 1.75 funding fee on a VA loan. So just be aware of that. The other thing to be aware of is VA, when you're discharged from VA, or even I think perhaps active duty, you can have a disability rating. Many people do, and it can be as low as 10%, and you're fully exempt from this funding fee. Now that makes VA a super attractive program for anyone who's in that situation where you're exempt from the VA funding fee. That becomes a very attractive program from a cost standpoint because you're basically eliminating that cost. And you'll see this is a excuse me, this is a significant cost, but it gets much higher when you put less down. So anyway, that's why we have those columns. So let's just kind of dig in a little bit. We're going to start with this column here. Let's look at this is someone who's not a first-time home buyer, and this is pricing I pulled yesterday. Today is May the 16th, so this has been in May the 15th of 2023. This is a conventional loan. A borrower doesn't have to be a first-time home buyer. He's got 740 credit, so he's got good credit. He's borrowing $500,000. He's putting 22% down. Well, you see that the rate's quite high. It spiked up again a little bit this week. There's no mortgage insurance because 20% down, no mortgage insurance required. So your interest and mortgage insurance factor combined is 6.917. So your payment would be this. There's no mortgage insurance dollars. So your total payment's that. And then there's no funding fee, right? So your overall, you're going to be comparing this payment and essentially this cost of money to the other programs. Now, conventional first-time homebuyer, this is where you see kind of the benefit, where FHA came, where Fannie and Freddie came in and said, look, we want to facilitate homeownership, especially for these first-time homebuyers who are struggling. So we're going to lower the cost. We're going to eliminate some of these adjustments to pricing based upon loan to value, credit scores, all of the above. They eliminate all that. Well, you see that lowers the rate for this buyer by about almost half a point. So that's great. Your payment goes down, and no mortgage insurance here again, so your payment is what it is, and there's no funding fee because this is a conventional loan. Now FHA, lower interest rate, but then you've got a 0.5 MI cost. Now the FHA has two types of mortgage insurance, or effectively one is called mortgage insurance, and it's a 0.5 factor when you put 20% down. So that brings your overall cost to 6.545, and then on top of that you have that 1.75 funding fee. So your overall payment is going to be a little bit lower here. Notice that here it's 3065. It's going to be a little bit lower than what you see over there on the conventional side, conventional first-time home buyer side, but you've also got this mortgage insurance factor. So now you're at 3272, which is higher than both of the conventional, both first-time home buyer and, well, actually it's pretty close to the non-first-time home buyer, very close to that, to the point where these two, I would say, are, if you look at these two right here, this one and this one, there's almost no measurable difference, except in order to get this one, you've got to pay this $8,750, and you have to come to the table with an mandatory clause, with an appraisal that can't be waived, all of those other features. So I would say, in this comparison, the FHA is going to be the loser. The only way that FHA would be the winning deal in this situation would be if your debt-to-income ratios were high. If your debt-to-income ratios were over 50%, and you had some other debt besides your housing debt, so your front-end ratio was below 50 and your back-end was over 50, maybe FHA would win out in that case. But if you're eligible for VA, this is a situation where your cost is considerably lower. Now, one caveat here. You'll notice down here I've got this section here, which I say, okay, but what would the equivalent rate be? What if I took these points, because I'm not having to pay points to get a conventional loan? What if I wanted to do an apples to apples and say, well, what if I took those points for FHA or VA and I used it to buy down the rate? Well, you can see the rate goes from 6.9 to 5.9 if you're doing an FHA using the 1.75 points. VA with 20% down is only 1.25 points. You're buying it down to 6.3. But you see your 6.3 cost of funds is pretty close to the 6.110. And that's a situation where you might look at it and say, look, if I'm VA eligible and I can get kind of pretty close to the same rate, I might go in with a conventional loan just because it might be a stronger offer. Or maybe you go in with keeping those two as possibilities. Maybe the seller will allow you to do that sometimes. You can kind of say, look, I'd rather go VA. It's going to be a little bit better for me, but I understand, I'm going to go in with an FHA. Not sure how practical that would be, but in this case, what I want to do is at least compare not just what are the no points to these point options. I want to compare, what if I use those points to buy down my rate? Big caveat here is that in all of these cases with the FHA, the VA, and the VA subsequent use here, you can roll those points into the loan so they don't add to your cash to close. You can't do that with conventional. You can't just roll them in to the loan. And so you either have to have more cash, or maybe if the seller's willing to pay, but just be aware of that. So that's how I compare that here. If I'm VA eligible, I might be, assuming market acceptance is okay for the VA loan. I'm not in a hyper competitive situation where I might might weaken my offer by coming with a VA, then I might go with a VA here. That might win if I'm eligible for that. If not, I'm going to go with either the conventional first-time home buyer if I qualify, or just a conventional loan. Now, this is where it gets a little more interesting. Let's look at lower 680 credit with 20% down. Now, you really see kind of the impacts of having a poor credit score or lower credit score on your overall pricing. Notice now that our conventional, now one thing to notice, this rate is virtually the same as before. And that's because, remember we talked about, Fannie and Freddie want to foster home ownership for first-time homebuyers, so they said we're waiving basically all adjustments that would relate to what they call loan level price adjustments, specific circumstances with regard to your loan. Property type, credit scores is a big one. And so you can see credit, interest rate, because of our credit, jumped up to 7.625 for this person who's not a qualifying first-time home buyer. And so their overall cost of money is 7.625, whereas The first-time homebuyer stays at 6.495. Payment goes to $35.39. And one of the things I want you to notice here is none of this changes whatsoever. And that's one of the things you're going to see, that FHA VA is going to be virtually the same throughout this presentation. Their pricing is generally not impacted by credit scores for sure. They're not impacted by credit scores at all. Now, where you're going to see an impact, FHA is slightly impacted once you get to 5% down or less. Then the MI factor goes from 0.5 to 0.55. Small price to pay. It's really kind of irrelevant. But kind of just FYI, the funding fee stays identical. What you will see fairly dramatically as the loan to value goes up, as we're putting less and less down, these numbers will go up quite significantly. And so we'll see that illustrated here in a little bit. But right now, just note that interest rates aren't impacted. Mortgage insurance factor is not impacted. Notice VA has 0 mortgage insurance factor. There's no monthly mortgage factor. There's just the one upfront mortgage insurance premium. And so just be aware of that. So here we have the principal and interest. That this went way up. Now notice we're comparing $3,500 a month to $3,000, $3,000, $3,000 here. So if you are not a qualifying first-time home buyer, you might be really tempted to go with these. Now again, looking at the equivalent points down here, you're at 5.9, and there's no mortgage insurance, right? Because we're still putting 20% down. So mortgage insurance hasn't been negatively impacted by the credit score, which it will later when it comes into play when we put less than 20% down. But right now, you can get an equivalent of 5.9. Well, that's still quite a low rate compared to the 6.545 or the 6.110. So even in this lower credit score scenario that we're looking at here, this borrower, if he has the extra cash and he wants to pay the points, he might go ahead and do that and still go in with a conventional loan. However, this is pretty enticing here. Both the FHA, and the VA are pretty. If you qualify for VA, I think you might, you might go in with that one here, because you see the payment is much lower here, of course, and the funding fee is still pretty modest with 20% down. And so that's a scenario. Now, if you're a first-time home buyer, this is probably, I would probably go take the slight payment increase. $3,159 versus $3,071 for the VA, $3,071 for the VA. And the reason for that, again, is because you're not paying that funding fee. So it's quite a bit cheaper in fees by not paying that funding fee. And you're going to go in with a little bit stronger offer because you're going in with a conventional loan. Now, we're going to look at 5% down. We're going to start with good credit, 740 credit, 5% down, same loan, $500,000. Notice here we've got, we're only putting 5% down. So the rate's higher than when we put 20% down, but significantly lower because our credit score came up again. So we're back to the scenario where we put 5% down, credit score is okay. Notice the MI factor. And notice the MI factor here too is it's going to be the same. These are impacted by credit, and they're not impacted by first-time home buyer considerations. Fannie and Freddie don't control that. And so mortgage insurance companies are private companies who come in and tell banks, look, we know that you are either not allowed to or not comfortable lending over 80% of the value of this home. We will insure the risk associated with that extra lending, and we'll charge a premium for that. And that's just called the mortgage insurance premium. And so they are very credit sensitive because they have to be. That's, someone who has a lower credit score has a much greater risk of default, and they have to come in and make good on that. Mortgage insurance is affected by credit scores, and in this case, we're talking 740 credit score. It doesn't matter if you're a first-time home buyer or not. You got a 0.29, which is a pretty low factor because credit's good, and we're putting 5% down. And so, but you do see that it brings the overall cost of money to 7.189 or 6.785. So here's your payments. Now again, the difference here is, remember, these guys have zero mortgage insurance. So we brought mortgage insurance into the equation here because now we put less than 20% down. We didn't have it before. Now FHA always has the mortgage insurance premium. We haven't reached the down payment threshold yet where that goes up, but again, it goes up very modestly, so it's not going to be a big factor. But we do see here that does start to tip in favor of these loans in terms of monthly payment. So in terms of monthly payment, but remember here, you've got this pretty sizable mortgage insurance premium. So again, you're probably close enough here where, I might still try and be over on these loans, because, here's the deal, especially when you have higher interest rate environment like we're in now, nobody knows what the future is going to be. But I think reasonable people expect that rates may be coming down in the near future, and may be seeing refinances happen. And if you do, you'll be glad that you took the slightly higher payment for a short period of time, so that you avoided this extra cost. Now, that said, you may be stuck with that higher payment forever. So just kind of factor that in. But again, VA here, if you're VA eligible, notice that this cost went up. Now we got to 5% down, and our VA funding fee went to 1.5%. At 5% down, it went from 1.25 to 1.5, so our cost went up. So, again, comparing, but we're sitting here at 6.110. We could buy the rate down with that $7,500, maybe to 5.875, but then we've got to add the MI factor to that as well. So we are really sort of, maybe we're kind of equivalents if we use those points to buy that down. But again, in this situation, we only put 5% down, and then we can't roll those costs if we pay points to buy that rate down into this loan. So that's going to impact how much cash we need to bring to the table. It may not be possible. So if you're eligible for VA, you might go with that. If not, in this case, you just have to kind of factor in what how important that slight difference in payment is, especially if you're a first-time home buyer. But even here, if you're a conventional, not a first-time home buyer, you might be willing to risk taking the higher payment, also to come to the table with a more competitive offer. Now, here we see a significant impact. Remember, our credit score now is going down to, we're at 5% down. We've got mortgage insurance, and we are looking at conventional first-time home buyer, same basic loan options we have here. And one of the things we're going to notice here is, boy, the mortgage insurance factor kicked up quite a bit. Now, this mortgage insurance factor is really just like, it's just like adding to the interest rate. 0.6 is adding, so like you see here, this is just like having an interest rate of 7.105. Now, one thing to keep in mind is that conventional mortgage insurance is potentially removable. And I say potentially, there's no guarantee that it can be removed. But if you get to that 20% threshold, or 22% in some instances, threshold of equity down the road, you may be able to have that mortgage insurance removed. So this doesn't necessarily have to be a permanent feature of this loan, but you should consider it, so at least going into it. Notice that typically FHA mortgage insurance is not. In some cases, you can remove FHA after 11 years. You can remove mortgage insurance if you put enough down. But it's 11 years is a very long time in a loan, and so it's hardly considered. You should hardly consider that as a possibility factoring into this decision. But in the meantime, you've got to deal with the payment, and you do see here, 3019 versus 3159 versus 3065. Again, this is here where the difference, if you're the first-time home buyer, is small enough. Oh, excuse me, I actually have to compare this to this. The difference is small enough here where I might again strongly consider this, with the potentially removing this mortgage insurance down the road, with the potential appraisal waivers. Now, I take that back. With 5% down, you're not going to get an appraisal waiver, so strike that from my remarks. But here, again, you have the extra cost associated with the funding fee that you don't have on the conforming side. At no time do you have a funding fee for conventional lending. And so no matter how little you put down or how much you put down, you're not going to have that funding fee, where you're always going to have that here, and you're always going to have it here as well, too. And so with 5% down, you are at $7,500 on the VA. VA is looking strong again here. Big payment differential after mortgage insurance is factored in, 3,071 versus $3,700 here. That's quite a big difference if you're not a first-time home buyer. Again, because the rate went up quite a bit because of your lower credit scores, but then MI also went up, and so this starts to suffer pretty mightily. And in this case, you've got such a big difference that FHA might be strongly considered. This is the lower credit score, 5% down. But if you got VA, VA is a good option too here. That's a much lower payment than the other options, and that might be the route to go. And then finally, let's look at 3.5% down. Good credit here in this case. Here we have conventional, 7.295 with mortgage insurance. So here we have 0.460 mortgage insurance, still pretty modest with good credit, 3.5% down. Your overall payment here, not a huge difference between conventional and first-time home buyer conventional. FHA is going to be $32.93. Still not a huge difference here. So again, I'm kind of favoring the conventional here, especially if you're a first-time home buyer. Maybe not if you're conventional here, because again, you've got that big fee. And just because they roll that in doesn't mean you're not paying it. I'm repeating myself here, but that is a cost, and it just gets rolled into your loan. But that means that it eats into your equity on the loan. It is a cost associated with getting that loan, and so this may be an option if your debt-to-income ratios are too high. But I would certainly go with this one if I had that as an option, because you're not paying those points to get that rate. It's only slightly higher, and maybe even this one as well. And then, of course, here's where you really start to notice VA. This is the difference between first use and subsequent use. The first use cost went up. Remember before it was $7,500. So for first use now it goes to $10,750. But if you're subsequent use, this is where it really starts to kind of hit hard. If you're a second use or third use, whatever, and you have less than 5% down, now you're going up to, I said subsequent use here, but I think that number is actually 3.3%. There is the funding fee for subsequent use, and so quite a big jump here on this VA subsequent use cost. And that's going to impact your monthly payment, of course, because that gets rolled into the loan, even though the interest rate's the same as it's been on every one of these scenarios, but you're rolling in a much larger amount into your loan, so your payment goes up. Now, here, again, VA has no mortgage insurance, so that is your total payment. Is that $31.33 compared to $34 or $33 or $32? And so here again, you just have to factor, can I afford this? And do I want to save the $16,000 if you're a second use VA, or $10,750 if you're a first use VA, and take the higher payment, hopefully only for a time, but you should go into it not depending upon that only being for a time, that you're going to be able to refinance to a lower rate. You can certainly hope for that. I think it's reasonable to do so, but you shouldn't depend upon it. And then let's go the last one, I promise. Last one, lower credit, 3.5% down. And here here's where it kind of gets ugly if you're not a first-time home buyer. It even gets ugly if you are, because the MI factor. Remember, the less you have down, the more risk there is, and the lower your credit score, the more risk there is. And these mortgage insurance companies know that, and they have to compensate for that by charging a higher risk premium. So you see a fairly substantial risk premium. Notice no rate premium. So here we're already down to 3.5% down on a 680 credit score, and basically we have a very small change in interest rate, hardly at all, for the qualifying first-time home buyer. So that's a real plus. But then you get hit with that high mortgage insurance cost. FHA mortgage only went from 0.5 to 0.55, hardly a change at all, but you go up to 7.385, total cost here 8.184 if you're not a first-time home buyer. And then of course you add the mortgage insurance here, so you got 37 versus 3200 FHA, or 35 versus 3200 FHA. And again, you got to roll this cost in, but these monthly payment deltas might start to be more important to you. And this is especially true with people right now. They're already struggling, right? Prices went up, rates went up, and first-time homebuyers especially are struggling to qualify. And so you may want to go here with that FHA, because now you're really getting hammered because of the impacts of mortgage insurance and interest rates for lower credit scores. VA, if it's eligible, still a strong option. Your lowest payment here, you see a big difference here, almost $700 a month difference between that and the conventional first-time home buyer. So I think that would be hard to ignore and walk away from, even if you did have to kind of swallow that higher funding fee. So that's really it. Show you a pretty picture of just the intangibles, right? Just having a house. It's a wonderful thing. Hope this has been helpful. I know it's been fast and furious, and like I said at the beginning, reach out anytime. If you like this stuff, share it, like, subscribe, share it with your friends, and yeah, until next time, thanks so much.